Welcome to your Mortgage Insider Update for this week. It is August the 26th, and we have come off the heels of the Economic Symposium in Jackson Hole, Wyoming, with the Fed chairman finishing his speech on Friday, leaving the markets little doubt that they will begin cutting at their next meeting coming up in September. So many would say that they should have cut back in July, and according to the rate charts, they sure should have right after the jobs report came out for July. That was back at the beginning of August, right after their last meeting. Since then, we've gotten a lot of economic information as far as inflation, and we are going to get another jobs report just coming up around the corner, which will help confirm to what level the Fed actually starts to cut rates. Will they cut it a quarter point? And if they do, how many more times will they need to cut this year to get on track? Or will they come out of the gate swinging and do a 0.5% cut? We shall see. Let's take a look at the charts. So as we start the week off, the 10-year Treasury has broken back below the 380 number. So 3.8% is that's been our line in the sand. That's the number that we got to back at the last jobs report. And now we've hovered just above that until today, coming off of the Fed chairman's speech last week. And we can see that back since August the 5th, that is the first Friday in August that we got our July jobs report, that was the last time we got below the 3.8 number on the 10-year. That has really started to become the bottom as far as rates this last week. We tested it back on the 21st, came right back to it on Friday after the Fed chairman spoke, and now we're testing it again today. So that's going to be our line in the sand, so to speak, to watch for. If the 10-year can drop below 380 and close there, that's going to be a sure sign that we're going to start to test lower levels on interest rates, with the 10-year being our main focus and barometer. With that, we are going to look at the mortgage-backed securities. Now, just to preface, the mortgage-backed security prices, this is the investor's price when they buy the mortgage-backed security from folks like us that produce loans. Their price will elevate. They will have to pay more for a lower interest rate to the consumer. And one thing I'll point out is we're tracking actually a 5.5% coupon as a pretty indicative of where we are with rates looking to go further down. The 5.5% coupon means that's the coupon, the percentage the investor is going to look to receive, not necessarily the interest rate the consumer gets. But since the investor is getting a 5.5% interest on their money, the consumer ends up paying a slightly higher interest rate to make up for all the costs associated within the mortgage industry in producing the loan, packaging the loan, and then, of course, selling it to the ultimate investor through the mortgage-backed security market. So we can see the prices similar to where we saw the 10-year exceeded this level on August the 5th. That was the last data we received. Similar to the 10-year, we fell back below that number, meaning interest rates hit their low point and then bounced higher, and then have manufactured their way right back to where we started. As we get into this week, we are expecting a lot of new news coming out this week with PCE. The Fed's favored measure of inflation comes out on Friday. So we're going to likely hang pretty close to these levels until we get the PCE number, and a substantially better PCE, lower inflation number, could continue to push the prices of the mortgage-backed securities higher, meaning interest rates to consumers can break below a level right now. They're sitting at around 6.5%, give or take a little bit lower than that starting out today. So we'll keep an eye out for you this week and come back with you in another update next week. But watch for that PCE number on Friday, as the next levels of lower interest rates are still to come.